If someone asked me where to start investing today, here are the 6 ETFs that I would send them to. These ETFs cover large cap, total market, Nasdaq, international, dividends, and growth. Now, every one of these ETFs is good at something, and every one of them also has a trade-off that you should know before you buy. Now, let's start off the list with an S&P 500 fund I'm going to name that a lot of people might not have heard of before. And this is SPYM, and this is the State Street Spider Portfolio S&P 500 ETF. Now, this ETF costs 2 basis points to hold a year. It holds roughly 500 stocks, and it's been live since November 2005 with about $160 billion in the fund. Now, when you think of the S&P 500, most people default to VOO or SPY, and I get it because VOO is Vanguard's version of the S&P 500. It's bigger and it's more famous than SPYM. But once again, it's the same 500 companies, and VOO costs 3 basis points while SPYM costs only 2. Now, 1 basis point like this truly won't be life-changing, but if you're buying the identical index either way, I'd rather pay for the cheaper one. This ETF is not necessarily obscure. The Treasury just selected SPYM as the default option for the new Trump accounts. Now, if we look at the holdings quickly, Apple sits around 8%, Nvidia's around 7%, and then there's, of course, Microsoft, Amazon, and Google. The top 10 holdings here add up to around 37% of the fund, and technology sits around 36% of the total portfolio. So the trade-off on S&P 500 is concentration. While you do own 500 companies, 10 of them are essentially driving more than a third of your returns. Now, over the past 5 years, the S&P 500 has returned around 13% a year, so that concentration has paid off very well. Now, number 2 is the Nasdaq 100, which is the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. And there's some history here worth knowing before I actually say which ticker that I prefer. QQQ launched all the way back in 1999, and this is the original Nasdaq 100 fund. It's got roughly over $600 billion of AUM in it, and it used to charge 20 basis points, but it recently changed down to 18 basis points. And in 2020, the same people in Invesco launched QQQM. And this is the same index, same exact holdings, but at 15 basis points instead of 18. And this ETF has roughly $100 billion in AUM. And then in June of this year, State Street launched QNDX at only 10 basis points. So these are 3 funds, this is 1 index, and there are 3 different prices on the back end. So the one that I would personally invest in will be QNDX based on that price. This ETF at the moment has roughly $145 million as this video is taken, and it launched only on June 23rd. So it's a couple weeks old. Normally, an ETF that young would sound the alarm bells in my head, but it's gone from about $93 million to $145 million in the last couple days. So money is finding it fast, and the newness of this ETF doesn't really worry me that much. The only real difference is the spread. So QNDX sits at around 4 basis points against QQQM's 1, so it's a little more costly to get in and out if you're trading. But if you're dollar cost averaging into this ETF and you choose to hold for decades, that spread on the current pricing is nothing next to the saving of 5 to 8 basis points on the expense ratio every single year. And then also, as this fund gets bigger and more liquid, the spread should tighten and be more comparable to QQQM. Now, the Nasdaq is up over 34% last year and roughly 16.5% over the past 5 years annually, and that's the strongest case for any ETF on this list. Now, the trade-off again is concentration. So the top 10 holdings are roughly 46% of the fund. You can see here that Apple's roughly at 8.4%, Nvidia's around 8.1%, and then we got Micron at 4.3% and AMD at around 3.5%. So you're buying a heavy semiconductor position inside a fund most people think is just broad tech, and the index trades at about 32 times earnings, which could be seen as a bit pricey. The third ETF on this list is VTI, which is the Vanguard Total Stock Market ETF. And this ETF is very cheap at 3 basis points. It holds roughly 3,500 stocks, and it's been running since May of 2001. At the moment, there's roughly $650 billion in this ETF. Now, this ETF holds every publicly traded company in America all in one ticker. So this is large cap, mid cap, and small cap stocks. The turnover on this ETF is 2.6%, so the fund barely trades, which means there's not going to be any surprising tax bill in a regular brokerage account. And this fund has been through a lot. It's been through the dot-com crash, 2008, and COVID, and still is compounded at roughly 9.5% a year since inception. And then now here's a trade-off on the other hand. VTI is weighted by market cap, so those 3,000 extra smaller companies in the portfolio barely move the needle. And once again, the top 10 holdings are still about 32% of the ETF, and technology sits around 35% of the total portfolio. And for over the last 5 years, VTI has returned about 12.2% a year, while SP 500 has returned about 13.4%. So the small cap and mid cap exposure you're buying really hasn't paid off yet in the performance. But at the end of the day, VTI and SP 500 are essentially doing the same job for you. If you own one, you don't necessarily need both of them. Real quick, if you're finding this useful, please hit the subscribe button. We're almost at 1,000 subscribers, so I would truly really appreciate any support that I can get. Okay, let's move to the last 3 ETFs. So number 4 is VXUS, and this is the Vanguard Total International Stock ETF. For 5 basis points, you get more than 8,700 companies outside of the United States. And this fund has been around since January of 2011. And this ETF is actually one that a lot of people skip, and it kind of makes sense. So over the past 5 years, VXUS has returned about 8.8% a year, while VTI has returned around 12.2%. But here's why this ETF is still on the list. So over the last 12 months, VXUS has returned about 27% compared to VTI, which has returned about 23%. And right now, international stocks trade at 18 times earnings, while the US total market trades at roughly 27 times earnings. That's about a third cheaper for a similar set of businesses. And it's also the most diversified fund on this list, with the top 10 holdings at only about 14%, with Taiwan Semiconductors at the largest position, weighting at 4.2%. Europe is about 36% of the weighting, while the Pacific is around 29%, and emerging markets sit around 26%. Now here are the trade-offs. The main issue here is currency risk. So emerging markets carry political risk that you can't plan around, and Vanguard themselves rate this emerging market risk a 5 out of 5 on their own risk scale. But if you own zero international, that's still a decision, and most people make that by accident. The 5th ETF on this list is SCHD, which is the Schwab US Dividend Equity ETF. It charges 6 basis points and holds 101 stocks, about $105 billion in the fund, and it has a dividend yield at around 3.2%. Now that's roughly 3 times about what the S&P 500 pays you. But the yield really isn't the reason to own it, it's the index that's the underlying. A company has to have paid a dividend for over 10 years straight just to qualify to be a holding in SCHD, and then it gets ranked on its financial strength as well. So what you end up with is a lot of high quality companies such as Abbott, Amgen, Merck, Coca-Cola, United Health, all having an equal weight at around 4%. And if you look at the exposure of this portfolio, healthcare is around 21%, and consumer staples are around 20, while technologies are around 13%. An interesting number is SCHD's beta, which is at 0.53. So SPYM and VTI both sit around 1, while VXUS is at 0.79. And in case you didn't know, beta measures how much a fund moves relative to the market. So 0.53 means SCHD moves about half as much compared to the market. So one of the major trade-offs of this portfolio is the amount of turnover it has. SCHD has a turnover at about 42% a year, so this fund trades a lot, enforcing its index rules. And that 3.2% yield is taxable income landing in your account every single quarter. So in a Roth or a 401k, that's a non-issue, but in a taxable account during your peak earnings years, it's an unwanted tax bill. And rounding out the top is SCHG, which is the Schwab US Large Cap Growth ETF. This ETF charges 4 basis points to hold, has roughly 195 stocks, and it's been around since December 2009 with about $60 billion inside the ETF. Now at that price point, that makes it the cheapest growth exposure on this list. And SCHG doesn't care what exchange a company is listed on, unlike the Nasdaq 100. So now here's the trade-off, and this is the biggest one in the video. SCHG's top 10 holdings are about 51% of the fund. Apple alone is nearly 10%, as well as Nvidia. And by looking at it here, that is more concentrated than the Nasdaq 100. Technology also sits around 45% of the fund, and it has a beta of 1.25, which is the highest of anything in this list. So that's the 6 starter ETFs. Now, once again, here's the job each one is doing inside your portfolio. The SP 500 is your core, and SPYM is the cheapest way to own it. VTI does that same job and hands you small and mid-cap companies on top of that. And if I were opening my first brokerage account today, this ETF is probably the simple and easiest way to start. QNDX and SCHG are your growth tilts. With these ETFs, you're paying for a higher valuation, but also faster earnings growth and accepting bigger drawdowns to try and catch that performance. VXUS is the diversifier here, and this gives you international exposure at a super cheap price. And SCHD is the steady income of the bunch. That yield is excellent when you're within 10 years of retirement for income and steady performance, but in your 30s, it may be worth your time to invest in more riskier investments. And most people I see often end up in one of these 3 types of setups. One setup I see a lot is core and international. So this would be VTI and VXUS, and then nothing else. Another one is core plus a growth tilt. So this is usually an S&P 500 fund and a Nasdaq 100 fund. Or lastly, 50-50 split in SCHD and SCHG. And this is something you see on Twitter or X all the time. The one thing I would personally avoid is buying all 6 in the same portfolio. And that is my take. Let me know what you guys think in the comments. Which of these 6 ETFs do you actually own, and what should I cover next? If this video helped you, please hit the subscribe button. You can follow me on all my socials, which is X, Instagram, and Substack. Also, if you want to track my whole portfolio for free, the Blossom social app link is in the description below. And then lastly, if you're ready to start investing today, my favorite brokerage accounts are also linked in the description as well. Now, thanks for watching, and I'll see you guys in the next video.